Afternoon, everyone. We're going to go ahead and get started here. My name is Marcelo with Phase-In Group, and just a little bit about us. We are your full spectrum broker, and we provide everything from benefits and wellness to HR solutions, compliance, and payroll. Today, we're going to be going over self-funding and level funding and how it can help control healthcare costs and get some of those unused claims dollars back. We have Patrick from Starmark here to help us out with that. Starmark is one of our partners and benefits experts, and Patrick is going to provide a lot of really valuable information for you guys. Patrick, if you could go ahead and move to the next slide, please. So just a couple important reminders here for this webinar. Please go ahead and put your phones on mute as you enter the room, as that will allow us to eliminate any unwanted noises in the background. If you have any questions, please enter them into the chat box, and we're going to go ahead and answer all of those at the end. We are also going to be sending out a follow-up email to everyone just to recap what we discussed here today and provide you with some more information. So Michael, I'm going to go ahead and turn it over to you now.
Thank you, Marcelo. Good afternoon, everybody. My name is Patrick Graff. I'm a company representative for Starmark, Trustmark Companies. What we're going to be going over today is who Starmark, Trustmark are, why are we offering what we call level funded or self-funded stop-loss plans, introduce you all to some terminologies with our plans, and also discuss on how this product works. A little bit of background. Trustmark is the parent company and has been in business for over 100 years. Starmark is the medical division of the Trustmark companies, and I have been with a company rep for 17 years now. Recently, in 2007 is when we started these products. The purpose of these products was to give you all as a business owners an alternative to ACA, Affordable Care Act, or fully insured plans with all the changes that started happening in 2010. These plans, they are defined as self-funded stop-loss plans. Other terminologies for these plans with other competitors are called level-funded plans or alternative-funded plans. Back in 2014, there was a survey done by Diringer Research Group, and they stated that Starmark, we are the leader in level-funded plans for small groups. So we have been doing this longer than other carriers, and according to the research group, we're the best in the small group market. When we talk about these next couple of slides, keep in mind that I'm competing and showing you an alternative to the status quo. When I say the status quo, I'm talking about ACA/Obamacare/fully insured plans. Those right now, most employers, and that is the only you as a solution to healthcare. I would ask yourselves if you currently have a broker and the broker is not mentioning or talking to you about alternative funded or level funded or stop-loss plans, I would ask them, why aren't they showing you this? And I can tell you from my experience, number one, they probably don't know how it works and do not want to be embarrassed by showing you something they don't know, or they'd rather just you stay on the fully insured plans. Now, the purpose of these plans is to bring you something different. These plans are not going to work for all styles of groups, but at the end of the day, at least you have an option to a fully insured plan. Now, with our self-funded plans, why do you want to do this? There's savings opportunities. There's convenience because we handle everything. There is no third-party administration. you have protection against large claims. One of the mistakes that people think of is when they hear self-funded plan, they think, oh my goodness, that's not good for my 10-person group because they could get hit with $1 million claim and the business owner is responsible for it. That would be the case if you were talking about 1972, 1973 traditional ERISA self-funded plans. But our plans are a hybrid. When I say a hybrid, it is claims be with your monthly premiums, but if the claims exceed a certain dollar amount, the insurance piece pays that remaining claim. So as we go into this, you'll see it again, but as long as you, business owners, make your monthly payments for 12 months, you will never owe a penny more based upon your claims experience for that 12 months. Now, with the ACA plans and fully insured right now, the employers having challenges. You've probably seen they've gone and shrink to community-rated based where there's no more underwriting and your employee rates are all over the board depending upon male, female, age, and so forth. You also seen increased ACA regulations. You also seen less flexibility with your benefits. Typically, a lot of those fully insured plans, you have to pick from a menu of plans. I call them rack plans. Pick something off the rack, and that's what you're going to get. So you can't control, really, the benefits within that specific plan design. We also see the rising cost of benefits year upon year. And there's also, I feel, in the fully insured world, a lack of transparency. What are you really paying for? In today's fully insured world, you get a plan, you make a monthly payment, and then 10 months later you get an increase, and you have no idea why. You just get an increase and have to shop and do this all over again. Alternative to this fully insured status quo world is this level funded product that we offer. And again, I would go back after this webinar and ask, is your broker even mentioning this product to you? Why Starmark Healthy Incentives? Lower costs by paying for actual claims at a discounted network access. We do have and use PPOs. So you will have a PPO network. Typically, it's going to be either the Cigna or the Aetna network. So you are getting those discounts by going in network.
There's no doubt. Also, they themselves said they could have handled it.
Also, all of our PPO plans have in and out of network access. With our plans, you have an opportunity to get money back. I will elaborate this more. But on a fully insured world, after you've been with the company for 12 months, regardless if you had excellent claims experience, you're typically not getting any of your unused premium dollars back from the fully insured world because your premiums are helping to subsidize the whole block of business. Why Starmark Healthy Incentives? Flexibility in plan designs. When I say that, we have flexible benefits to customize to your liking. You want a deductible starting with 0 and going all the way up to $68.50? We have it. You want a co-insurance of 100%, 80%, 70%, 50%? We have it. You want co-pays anywhere from 20 to 60? We have it. You select the benefits that work for you versus a fully insured carrier limiting which plans you can select from. Also, in regards to transparency, you're going to have knowledge of where your claim dollars are going. We would send to you, the business owner, a monthly report showing you this is how much money you paid this month, this is how much money in claims were spent, this is what you have left. Also, every 6 months, we send out a detailed report with no PHI information on it, so you don't have to worry about PHI. But you'll have a breakdown of all of the dollars that were spent on your claims for those 6 months on your group. It'll be broken down by preventive services, RX services, CPT codes, diagnostic codes, so you can see where your money is going and knowing that these claims are being processed. Key advantages to Starmark. And I'm going to talk about this definition a little bit later. Stop-loss insurance and self-funded plan designs are bundled, less hassles. What that means is your liability as an employer is to make one payment once a month for 12 months to Starmark. That's it. We design these plans to look, feel, and smell just like a fully insured plan. Your employees are going to have their ID cards. You're going to get a billing statement. You make one monthly payment. You don't do anything else. Starmark does the administration of your claims, and Trustmark does the reinsurance of your large claims. So there is no third party involved in these plans. Conversely, there's some competition that have third parties, and by just naturally, it takes longer for those claims to go from point A to B to C to D. Since we do it all, it's less hassle. Aggregate claim liability, we talked about claim utilization. We do not laser, that's a terminology in the self-funded stop-loss plan world. We do not laser. What that means is we are not going to give somebody in your group that might be a higher risk a different plan benefit than everybody else. With these plans, when we talk about the benefits and so forth, all of our level-funded stop-loss plans do meet the requirement established by Obamacare in regards to qualifying for major medical coverage. Also, all of our plans do offer and come with 100% preventive care, just like fully insured plans do. So even though this is a level-funded plan, you go get a routine physical, mammogram, pap smear, oculant blood test. Those still fall under preventive services and don't cost you anything at the time of visit. Another important aspect is with the ACA and fully insured world, there's certain quote-unquote taxes or fees associated with these health plans now. The one nice thing about offering level-funded plans is we and you as an employer, we do not have to pay what's called the health insurance tax. So there's a tax advantage with these types of plans. Summarizing key advantages to this, you're going to have monthly costs reflect expected claims, stable monthly payments, money back when medical claims are lower than anticipated, access to our PPO networks, protection against those high dollar claims, aggregate and monthly reporting on where your claim dollars are going. And again, we do not, and you do not have to, you do not, and we do not have to report health insurance taxes or pay those taxes. Now I'm going to get into some terminology with these plans, and I kind of wish they made the terminology a lot less simpler. And the terminologies we're going to talk about are the aspects of these plans in regards to behind the scene. I already mentioned to you that the benefits are more flexible than fully insured. So we have better benefits, but it's the behind the scene stop-loss insurance that people don't fully understand how it works. And those definitions are the following. With these health plans, on a monthly basis, when you make your payment, you are paying for specific and aggregate stop loss. Now, I don't like these terminologies, but that's what they are. when we say stop loss, just think about insurance, okay? And when we talk about specific, the specific stop loss will pay covered claims over a certain amount of a specific person. Basically, what that is saying to us is, should anybody in your group have claims that reach X amount, once that individual reaches the claims of X amount, Trustmark would reinsure and pay all the claims after that dollar amount has been satisfied. So when you hear specific stop loss, think of individual protection. Now, when you see aggregate, well, let me stop here. Specific stop loss levels, state mandated minimum levels apply. So for example, if we have a individual stop loss of $25,000 on your plan, and one of your employees has a ACL knee surgery, and that total amount is $40,000 for that ACL knee repair. Once the employee has paid their deductible and out-of-pocket maximum, the most that would come out of your group claim fund, which we haven't talked about yet, would be $25,000, and then Trustmark would reinsure and pay that remaining claim. The reason for that is the fact of we don't want one individual to wipe out the entire claim fund. And I'm going to go back to what claim fund means in the next slide. Secondly, you have another type of insurance called aggregate stop loss. Aggregate stop loss will pay covered claims over a certain amount of the entire group. So you have an individual protection and then a group total protection. Trustmark assumes financial responsibility for all claims exceeding the individual and the aggregate limits. No additional funds are required on your behalf, except your only liability is to make your payment for 12 months. Now, when you make a payment, it's comprised of 3 components. Unlike your fully insured plans, you get a bill from whoever it may be. You see a total amount, you pay it, and that's it. With our plans, you're paying for 3 components. You're paying for the claim pre-fund, which is the claim pre-fund or aggregate account is used to pay covered claims. Secondly, you're paying for stop loss premium. That's the insurance piece that we just talked about. Thirdly, you're paying for administrative expenses, which is us for administrating the pays, getting the network discounts, creating ID cards, sending out certificates, and so forth. So those 3 components make up your total payment. Now, just for an example, let's say that the claim pre-fund amount is $2,000 and the stop loss premium component is $2,000 and the administrative expenses is $2,000. That would mean that as an employer, your total amount would be $6,000 a month. That's your liability. That's what you'd pay. You'd write a check for $6,000 to Starmark. What we do is we're going to take $2,000 of your money and put it in an account, which is called the aggregate account or the group claim fund account. And we're going to do that each month. So technically, $2,000 a month times 12 months, you would have put into your aggregate account, which is your group fund. It's strictly used to pay claims on your group. It's not used to subsidize everybody else in the area. It's just for your group claims. So you would have had put in $24,000 in your claim fund. That is the money that we use to pay for your employee and dependents claims throughout the year. It is a fixed monthly payment subject to if you add or subtract employees off the plan. And these plans are, you'll hear a terminology called max funded. Your monthly payment to us includes run-out protection. It includes the administration of your plans. There's no additional cost on anniversary. So that $24,000 is what we're using to pay your claims. Now, what is going to happen here is, let's just say that at the end of the 12 months, you've had put in $24,000 in your aggregate, which is your claim fund. And you would have done that by making 12 months of payments per the math that I've used as an example. Let's say that your total claims for the year only came out to be $14,000. That means that you have a surplus of $10,000. You have the opportunity now to get your unused premium dollars back because you have a surplus. So it's almost a profit sharing, because if your claims run good, you have the opportunity to get your claim dollars back, okay? Conversely, if we are using an example, you have a claim fund of $24,000, but you had a total of $44,000 in claims, you do not owe a penny more, because your payments that you made to Starmark include that stop-loss insurance. So Trustmark is paying that additional $20,000 in claims. Now, the next question people say to me is, well, if we exceed our claim fund, what's our renewal going to be next year? And the answer to that question is, it all depends on what those claim dollars were for. What I mean by that is, in order to get these rates and finalize these rates, unlike fully insured plans, each of your employees would need to complete a 9-question health statement. In the fully insured world, you do not need to ask and fill out health questions. In the self-funded world, you must fill out health questions, because we are giving you true insurance, which is a rate for your risk. Now, with that being said, there are going to be times when a group is going to be better off going with fully insured product versus a self-funded stop-loss product. The reason for that is because the fully insured world does not ask health questions, and it doesn't matter if the individual is healthy as a horse or unfortunately has a chronic disease. The rates are the exact same. With the self-funded product, you're going to be seeing the rate that you should be paying based upon your group overall health risk. So if there was a 10-person group that came into us and there's no health conditions whatsoever, they're going to have a better rate because their risk is lower than a 10-person group, unfortunately, where all 10 individuals are currently going through chemotherapy treatment at this current time. So the only reason why some people do not accept our plans is simply for the fact of the applications show a higher risk and the price is better for a fully insured plan. Now, going back to my example in regards to, you have $24,000 in your claim fund, however, $44,000 in claims were paid out. Well, you're not going to owe a penny more, but what's your renewal going to be? It all depends on what we expect the next 12 months of claims to be. For example, if the reason why you went over your claim fund was a shock claim, somebody got hit by a bus, there was some sort of catastrophic accident, and there's no future treatment needed, that is not going to negatively impact what your renewal rate is going to be. Conversely, if we see a new diagnostic code come in and can forecast that, okay, this person was just recently diagnosed with cancer, and unfortunately for the next 12 months in the renewal, that cancer is still going to be there and treatment is going on, then yes, that would increase your monthly payment and increase your renewal. However, if you terminate our plan on anniversary, again, you don't owe a penny more because you already fulfilled your 12-month obligation with us. And remember, you're getting that monthly report every month to see how many claim dollars are being spent each month. So if you see on the claim report there was $1,000 this month, $500 this month, and all of a sudden there's $22,000 the next month, you probably can figure out, okay, something was going on within the group, and then when you get that 6-month report, it's going to show you the dollar amounts, no PHI, but just dollar amounts of how much these claims are costing. Another differentiation between us and other carriers is, should you have a surplus? And since 2007, 49% of our groups do receive a surplus. With our surpluses, you have 4 different options on how you'd like to receive your unused money back to you. With our self-funded stop-loss plans, they only are not required to cover insurance mandates via the state. These are ERISA-type plans, so we only have to follow government guidelines. Many brokers and many business owners, after we talk about level-funded plans, they always say to me, well, Patrick, this sounds too good to be true. You're saying if we don't go through our aggregate amount or our claims fund, we can get a surplus back. And you're telling me that if we blow through our aggregate/claim fund, we don't owe a penny more because of the stop-loss insurance kicks in? Why aren't more people on this type of plan? My answer to that is 2 reasons. Number 1, the broker is not showing it to you. Or number 2, after we went through underwriting, the risk was higher, so the fully insured rates looked more appealing, and hence the business owner decided to go with the fully insured plan because of the rates being less than the self-funded plan. So in my opinion, those are the 2 reasons why people aren't going with these types of plans. And the one thing that me nor your broker can control, nor you can control, is how the employee completes the medical application. And again, at the end of the day, all we want to do is let you know as an employer there's other alternatives out there besides just the status quo. Now, where is there a potential of danger where the employer might be liable for these plans? And if you notice during my whole webinar, I've always talked about making a payment for 12 months. If you make a payment for 12 months, you fulfill your contract obligation to Starmark. As long as you make your 12 months of payments, you will never owe a penny more, period. Where you could get in trouble is if you cancel the plan mid-year. So remember my example of putting $2,000 into this claim fund as just an example, and we said each month you make a payment and we put $2,000 into your account? Well, let's say we did that for January, February, and March. And at the end of March, for whatever reason, you cancel the policy. We would have had collected $6,000 into your aggregate. again, aggregate means your claim fund. You cancel in March. Starmark, we will pay and administer those claims for services rendered in January, February, and March. However, if those claims exceed the $6,000 that we've collected and put into your claim fund, then it's on the employer to pay that difference. So again, make sure you make your 12 months of payments. If you cancel mid-year, you could be liable for claims not being covered. Additional highlights with our plans: it is a nationwide network where you're going to be using either Aetna or Cigna based upon the zip code of where your business is. All of our plans offer teledoc, which is a phone or video doctor's consultants for a copay. Instead of going to the doctor's office, you can go online or make a phone call and get some prescriptions or some diagnostics. All our plans have what's called ground rounds, which is a medical second opinion. If your doctor says you need this and you feel like you want a second opinion, we provide that for you free with an independent doctor group. We also have optional benefits of Your Care Health and Wellness Program via the website. Care Champion 24/7, that'll help you find how much a pap smear costs at this location versus another location, or durable medical equipment and so forth. With the enrollment, 90% of the enrollment now is done by telephone or by a website. So if you decided that you wanted to go with Starmark and you send to the phasing group, here's the census of all the individuals, we will create an enrollment guide that'll have the telephone number as well as the 9 health questions that will be asked. Your employees dial this 800 number, answer 9 questions, hang up the phone. They're done within 5 minutes. They do not need to complete any kind of paper application. Or they can go to a website, answer the 9 questions, submit it, and that would complete the enrollment. Once the enrollment is completed, you as a business owner, you are not contractually obligated to go with Starmark. All you are doing is giving me the tools and the information to assess the risk and give to you final numbers. At that point, that's when you make a decision, either by a recommendation from your broker, or your decision is to do a fully insured versus the Starmark self-funded stop-loss plans, simply because there's a big rate difference based upon the risk within the group. In closing, Starmark, our motto is personal, flexibility, and trusted. Experience Starmark unparalleled professional service. Employees can choose from flexible plan designs, and employers have trusted Starmark since 1985, and Trustmark has been in business, Trustmark Life, for over 100 years. So that is my quick presentation, and I hope that employers, brokers, and everyone online got a little bit of something that they didn't know about, or now have figured out the myth of self-funding with stop-loss protection is an option for small groups. And I thank you for your time, and if there's any questions.
Hey, Patrick. Yeah, we did have a couple questions come in. One of them was, does this work with third-party hospital gap plans?
Yes, because our plan, all we're doing is giving you a major medical plan. And I have some brokers that will show a plan to the business owner, and for example, we're going to do a $5,000 deductible copay plan, and then the broker also puts in a gap plan to cover that deductible. That's fine. Absolutely, you can do that.
Okay, perfect. And what are the percentage of companies that enter something like this that see money come back at the end of the contract?
49% of our groups get a refund.
All right, and one last, we had another question come in just now. Is there a limit of the number of employees to participate in this program?
We do anything from 5 to 250 employees enrolled.
Okay, perfect. And how is the 1094 and 1095C reporting handled?
How that's handled is by law, being that it is a self-funded stop-loss plan, Starmark cannot make the 1094, 1095 reporting. The employer must do it themselves. However, what we do supply to the business owner is the number of lives that we have calculated that has been on the books with us, and that's the number that the employer with their broker does the calculation to the pay.gov for those 1094, 1095 reportings.
All right. Thank you very much. That seems to be all the questions we had today. So just a quick wrap up. I just wanted to remind everybody that you will be receiving an email from Phase-In Group. It's going to cover everything that was covered here today. You'll have a recording of the webinar. And thanks for attending, and thank you so much, Patrick, for doing such a great job presenting.
Thank you very much. You all have a good rest of your day. Bye-bye.
Thank you. Bye.